Who doesn't want to make 100 times their returns? If you buy a stock for $1 and if that stock becomes $100, wouldn't that be awesome? So that's the key topic of this book, 100 baggers. So the key learning for me are summarized in these points, the biggest one being patience. This book was inspired by one of the talk that Christopher was in with Chuck Akre, where he mentioned this book by Thomas Phelps, 100 to 1 in stock markets. So this book builds on top of what that book did. And the biggest key learning is patience. Like, you need to sit still and hold once you have bought your stock. A median 100 bagger that's analyzed by both of them took nearly 25 years. So forget the monthly returns. Even at the 20% annual compounding, you need 25 years to have a 100 bagger. And even 36%, 15 years. So, be ready for 25 years. And that requires you to sit still, hold your investments. And gambling with price fluctuations is not the way to build enduring fortunes. It's pure gambling when you keep buying and selling, and it's very hard to make money. And the only way you will not gamble is by improving your conviction in the stocks and the businesses that you own. Because these stocks will correct 50 to 80%. Even Berkshire Hathaway moved down by 58% between 1972 and 75, as quoted in the book. So really great quality companies will correct 50 to 80%, not once, not twice, but several times during your 25-year period. So you need strong conviction to hold. So in the meanwhile, read, learn about the company, learn about the competition, and build your conviction. The second area was around this new concept of coffee can portfolio, which is buying compelling stories and forgetting about those units that you bought for at least 10 years, right? So Robert Kirby in 1984 wrote this article in the Journal of Portfolio Management, where he first introduced this idea of coffee can. It basically helps you to save yourself from yourself, right? And I think it builds on this idea that mathematically long series of short-term bad decisions, slightly bad decisions, is mathematically more probable to be worse than one really bad decision today. Like if you buy something and hold, but you hold for a long time, then time, if it's a good company, is on your side. So basically, the way you implement coffee can and implement patience is take 10% of your portfolio, buy really compelling stories that you believe is a leader or will be a leader in the future, or a country that you feel is going to prosper, and use that money and only allocate that 10% or whatever percent you allocate for coffee can, such that you're okay losing it all, because it has maximum risk because you're not going to look at it. But there is a possibility that you make big amount. And the time horizon needs to be at least 10 years, meaning you're not going to look at it for 10 years. Because annual and quarterly returns don't really make a big impact on those long-term compounders. So once you've done your homework, once you've seen that, hey, this is a good company, good management, good return on investment, consistently growing and has a huge runway in front, just stop looking for 10 years. That's a big ask, because there's going to be lots of ups and downs, lots of market news. People will be talking about stock for, many times when there is euphoria or depression. So especially when the average life of a company in the US is shortening every year, it becomes very hard, because the company may not be existent. Maybe half of your portfolio may not even exist, but the really good ones will give you 100 bagger, and that will take care of the rest of your portfolio. So really novel concept of the coffee can portfolio is introduced in this book. And I think that's a really good way to build patience. The other area that I learned was around management. And there's a reference to this book called Outsiders where there is a study done of these operators or CEOs or people who have already done 100x return. And what are the key learnings for them from that book is a CEO has 5 types of decisions: invest in existing operations, acquire other businesses, pay dividends, pay down debt, or buy back stock, right? Which is, if you buy back stock, you're going to use your cash. If you pay down debt, you're going to use your cash. And so how do you use your cash, right? So that's the 5 types of decisions that you as a CEO make. And there are 3 ways to raise money. You issue equity, you issue debt, or you use your existing cash flow from your business. And there are really good traits of good management, the biggest one being they're able to allocate capital well. So excellent capital allocation, which you can look at by ROCE, return on capital employed, and look at whether they are actually improving the earnings per share, and the free cash flow is getting better and better, free cash flow yield is getting better, free cash flow compounding is getting better, and that they have decentralized empowerment of entrepreneurial spirits that help make better decisions. And those CEOs have independent thought. They may be contrarian, but they think long term. They buy back stock of their own company. They're very patient when it comes to acquisition. So these are some really good areas when we have to evaluate management that we learn from one of the chapters in this book. I'm going to read and review Outsiders at some point. Looks really compelling. The other big area of learning from this book is concentration. The question is, how big should you invest in a strong conviction of yours? Should you buy too many, like 10 stocks, 20 stocks, 50 stocks, 100 stocks? It's a common question. So the author prefers to bet on few ideas, but bet big. And concentration depends on how much insight you have, or how much information edge you have, and what are the odds you have in your favor for the upside of the stock versus the downside. So if you let's say invest $10 and you make $1,000, 100 bagger, but if you're a millionaire, that $100,000 will not make you rich. So when you hit 100 bagger, you want it to matter. So putting in large sum of money is equally important. You don't want to own a zoo of stocks. It's essentially the key idea that the author is trying to convince us, because you will at best not have any idea really in depth about the companies that you own. You will have mediocre results. At the same time, I feel diversification is equally important. So concentration is important, but diversification as a stopgap where you diversify enough so that you can sleep well. Stock buybacks is another big area that we learned from this book, which helps accelerate returns to investors, because earnings per share is, if the share count is going down, you're going to improve the EPS. So look for companies who are buying back their stock, because in a sense, a company that buys its own stock is buying the earning power of its own self, or earning power of the company that it knows in depth. If you buy your own business, you're going to get it at least at a 50% cheaper price than you're going to buy some other enterprise. So buying back stock is a huge, efficient allocation of capital. But you only buy back if the value that you're buying your company, it's well below its intrinsic value. If it's trading really high, then you don't want to buy back your own stock. The other area is moat, keeping your competitors out so that you can sustainably generate your margins, your cash flows, is the role of moat. Moat protects the business so that your competitors don't attack you or eat into your business. It makes your company more durable. It helps you with your free cash flow, because at the end of it, valuation of a company, or the value of the company today, is the discounted value of its all future cash flows. So if your future cash flows are more durable, then you're going to be more useful, and you're going to be, as a company, more likely to win and stay in the business. And remember, winners keep winning. So as you get bigger and bigger, your moat gets better and better. So it's important to understand and find out what is the moat of this company. And The way you look at moats and try to identify moats is through financial documents. You look at if the company has supernormal profits, very high margins, gross margins, net margins, profit after tax is really high, consistent, return on capital employed is high, they're reinvesting their money, the working capital cycles are on their favor. These are some really good things that you can find out through accounts. And one other way you can do it is look at, like for a car industry, look at all the components that a car needs and find out who has the best margins. That gives you who has the best margins, who has the best profits. That gives you like who has power, who has a high moat. And there are some examples given, like Apple, like 40-50% gross margins. Tiffany, people buy not the item as much, but for the box. They buy Tiffany products. Switching costs are a huge ingredient that banks use, because once you set it up, there's very low chance that you will change your bank, at least for 10 years. Network effects, Facebook, LinkedIn, Microsoft, with its operating system, right? Once you start building for that operating system, it gets easier and easier for more people to build for that operating system. Low cost, Walmart, right? Big scale economics like Intel. Like you might get to a stage where you need 55% of the market just to break even. Example, Intel. So very hard to get that kind of a market share, and so you need lots of investment, really high capital expenditure to even compete. And picking industries which are less vulnerable to technology disruption is very important, because technology is eating the world. Software is eating the world. So sodas is an example. Blood tests is another example which humans need. Those are businesses slightly more insulated from technology disruption. All right, so now we're going to go through some of the miscellaneous or the key ingredients for 100 baggers. The biggest one is you need twin engines for a 100 bagger. The first one is growth in earnings, and second one is growth in PE multiple, or the multiple that the market is willing to give you and your growth. Typically, a PE re-rating happens when there is an accelerated growth in earnings, and that's why earnings is the most important. Motilal Oswal with the India study published the SQGLP study, which is really amazing as to how 100 baggers came about in India, and some of the in-depth report is done around those companies. And in a sense, it's about having the vision to buy those companies, to see those companies, and the courage to buy those companies in good quantity, because only then it matters. And then having the patience to hold. So what is SQGLP for 100 baggers? So the company needs to be small in size. That's obvious, because if you have to become 100 times, you still got to be very small if you want to be, because let's say you buy a $2 billion company, 100 times of that is 200 billion. So in United States, there are many companies over 200 billion. So you could foresee that that's possible. But if you buy a $20 billion company, which is just 10 times the 2 billion, then that company has to be a $2 trillion company. There's only four or five companies in the US that are $2 trillion companies. So size is important. Quality has to be important of the business with high margins, and should have enough growth runway so that the business can reinvest in itself. So capital allocation in the business should be good. Also the management who are making those decisions. Earnings should be high. It has to have longevity in quality and growth. So it has to have a durable moat. That's longevity, right? And price should be favorable. You don't want to be paying too high of a price. Then it's going to be very hard for you to make returns. But remember, earnings is most important. But remember, earnings omits several things. The biggest one being earnings doesn't look into how much investments going into capital expenditures. Doesn't look into your working capital changes, account receivables, account payables, inventory days. So And most importantly, the long growth producing intangible results that you get from R&D assets and investments. So you need to look at all of that. So but without earnings, none of this is important. So you have to have earnings, but on top of earnings, you need all of these things to be on your side. So high return on capital employed, greater than 20% is a good rule of thumb, and seeing that they can reinvest. This, I think, is the most important point, because if you can't grow and if you can't reinvest in yourself and keep growing, there's no way you're going to get to 100 baggers. Having an operator or a founder running the company like Jeff Bezos for Amazon, we have Steve Jobs for Apple, we have Bill Gates for Microsoft. They had skin in the game and they were there for long term. They were not hired guns. They were not agents who would be worried about perception, who wouldn't take contrarian calls that are important for the company to thrive, and who wouldn't be worried about their prospects in decision and the career choices that they have. They are an owner and an operator. So there is a really good fund called Wealth Masters Funds that I will check out later too, which has which invests in folks who are owner operators, which have 500 million in assets as an owner and 100 million in ownership in a company. So that's a good way to track insiders or owners. And you need large earnings growth, right? Where you have a big international market, you see a big trend like Jeff Bezos saw with e-commerce, moving from large retail shops, brick and mortar shops, to e-commerce or internet-based commerce. And you need multiple expansion, as we saw growth in PE. And the way you find out moat is through looking at various metrics in the financial statements: ROA, return on assets, return on invested capital, return on equity, price to free cash flow, price to earnings to growth in earnings, the PEG ratio, 1 or less than 1. And if the investor, Charlie Munger shared a really good quote, and I'm quoting him here. He says, if a business earns 20% on capital over 20 to 30 years, even if you pay an expensive looking price, you'll end up with a fine result. So it's basically saying entry price can be discounted a little as long as the business is really good. But remember, if you pay a high price, as we saw here, then you're not gonna get a 100 bagger with a high probability. So important. Cash is important when it comes to depression or recessions. If you are not able to stay in the game and stay invested, because there will be times when the market will correct 40, 50, 60, 80% of your stock, then markets will turn ugly, and they have, history has shown, turn ugly several times. So you need to be able to stay in the market in bad times, and you need to have the attitude of equanimity in not reproaching yourself or taking it too seriously, where you feel depressed, because as professionals, if they miss a point in, let's say, a basketball game, they go back, they learn from the mistake, and then they focus on the next move, the next play. So investing is more about improving your behavior, getting really good at your behavioral science, the mental game of not really trading as much, investing for the long run, learning, not following the crowd as much, and protecting yourself from yourself, right? So being in and out of the market, trading, it's very hard to make money. You look at business cycles, you look at entry exit points with technical analysis, and you try to make money with that. It's very rare, and very few people make it. So staying away from it, staying away from the turnover game where your broker mostly makes money and you don't, is important. You will at best get intensely sick and tired, because you are constantly watching every tick of the symbol and you are awake for a long period of time, not doing the real work which you are really good at, and your life will be miserable. It's not worth it. And the last few ingredients is selling is only when you feel that your thesis is no longer valid, the investment criteria, there's a big impairment in the business, and you made a mistake. And lots of distractions will come in terms of news, Federal Reserve actions, currency movement, market performance. There are many reasons for you to get bored. So figuring out how to fight your boredom is the most important way in which you make a lot of money. So reading books, talking to people, reading annual letters, conference calls, learning about competition, this is what will help you. If you have a time arbitrage of looking beyond a year, you already are a winner, because a lot of people don't have that arbitrage. Reading conference calls, not listening, which questions are being evaded, what initiatives are disappearing, which questions are staged. Auditors, remember, they say, whose bread I eat, his song I sing. So very hard to find out disclosures, which are very hard to decipher. So board seat for most folks is used as a perk and not a responsibility. Lawyers hide innumerable acts of corporate wrongdoing. Market research is the objective to sell. China, no fraudster in China has meaningfully been punished for defrauding North American investors. Better to just stay away. Inflation. Asset heavy businesses earn low rates of return. This is an important exercise. You lose your purchasing power as inflation goes up. And remember, it's very hard to get really good businesses dirt cheap because there are many friends of good businesses. Avoid the fad of the day. Meme stocks is an example. That's today. Hot flavor of the month. You barely can make money. Berkshire Hathaway was a really good case study, epic case study in this book, where they have a negative borrowing cost. They have long-term commitment, really good owner operators, and really good references in the book that I will link in the PDF that's in the description of this video. And I've also written down this entire presentation in a Word document that's also linked in the PDF, in the YouTube video description. So go check it out. There are several good books that are referenced. There are also links to really good things that are referenced. Most likely that I'll paste in the description of the video. So that is the summary of 100 baggers. If you have personal experience or have hit a jackpot of 100 baggers, share your comments or questions or insights that you've learned from investing and not trading. So that is 100 baggers. May all of us who are watching this video hit at least 100 bagger in our lifetime. Happy investing.